The Federal Reserve kept U.S. interest rates unchanged despite pressure from President Trump. The benchmark rate will remain between 4.25% and 4.5%, where it's been since December. Fed Chairman Jerome Powell explained that decision yesterday.
The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
Now, this morning, President Trump slammed Powell, calling him a fool. He said there's, quote, virtually no inflation and, quote, tariff money pouring into the U.S. Let's chat now with the business editor at the Dallas Morning News and CBS News contributor, Javier David. Javier, of course, there is inflation. Good morning to you. But what else did we hear from Powell that really jumped out at you?
Well, look, for me, we heard a Fed chair that's very unequivocal about the impact of these trade levies, which act as a tax, and sort of how they skew both the employment market and inflation. And the central bank is insisting that they need to be cautious on rates. So in short, the Fed's making it abundantly clear that they're in no hurry at all to cut, regardless of how many sort of biting Truth Social posts the president dashes off in the middle of the night or early in the morning. That caution is a direct consequence of the inflation risks posed by the tariffs, which are both simultaneously eating into growth and sort of exerting this chill on the labor market.
And Powell was also clear that tariffs would increase inflation, they would decrease productivity, perhaps increase unemployment. What would it take for the president to get his wish? What would it take for the Fed to cut rates?
Well, I mean, suffice to say, it doesn't help that China just cut their own rates yesterday, the day before, while the Fed stands pat. So that sort of increases the president's anger, but it also shows, how having unified control over economic policy making lets the government respond. Here in the United States, we have a system where the central bank is independent. So the Fed didn't create this conundrum, but at the same time, it's going to be their problem to solve. And it's really not clear that what ails us can be solved with lower rates. It really is all about the tariffs, and it's what the market in particular wants to see. They want to see a rollback of these tariffs because they're just not helping the economic outlook.
And for people watching, they may find it difficult to feel any difference from rates remaining unchanged. What impact does it have on people's finances?
Well, look, unfortunately, if you're hoping for relief on that high credit card APR, if you're on the sidelines waiting for a favorable mortgage rate, unfortunately, brace yourself for a longer wait. And by the way, this is wreaking havoc on the auto industry. Toyota just this morning announced, overnight rather, that they're going to be expecting a profit hit of $1.3 billion for April and May, and it puts the sector, quote unquote, in flux. So it's really just not a great time to buy a car either.
All right, Javier David with the latest for us from Dallas. Thank you.